Ladies and gentlemen, one of the things that we're talking about, we heard today, is balancing human behaviours. And if we look at human behaviours that we're seeing at the moment across those people who are shareholders and therefore influencing those people in leadership positions, we've got this balance between what you might call the trade-off between short-term, which is a single-period concept, and long-term value, which is a multiple-period concept. And many of you may have read Larry Fink, the CEO from BlackRock's, his letter that actually talks about capital markets being the driver of short-term behaviour and the fact that boards need to rise above it and act in the long-term interests of the company. Now, you do see movements like the modern corporation, conscientious capitalism, amongst others, that have been speaking about this. Now, for the people who haven't read this document, I'm not going to read the entire letter, but I will read the first paragraph, which I thought was quite interesting. Over the past several years at BlackRock, we've engaged extensively with companies, clients, regulators and others on the importance of taking a long-term approach to create value. We've done so in response to the acute pressure growing with every quarter for companies to meet short-term financial goals at the expense of building long-term value. This pressure originates from a number of sources: a proliferation of activist shareholders seeking immediate returns, the ever-increasing velocity of capital, a media landscape defined by 24/7 news cycles, and a shrinking attention span, and public policy that fails to encourage truly long-term investment. He does then go on to say, at BlackRock, asset managers like BlackRock have an important role to play, which is why we engage actively with companies on the key governance factors that, in our experience, support long-term sustainable financial performance. Now, when you read something like that from an organisation like BlackRock, I think it's like laying down the gauntlet. And in essence today, our next speaker, ladies and gentlemen, the Managing Director of the KBA Consulting Group, is going to work on the fact that Larry Fink has posed the problem and is going to present a potential solution. Ladies and gentlemen, would you please join me in welcoming the man who authored this book, and also has got an article in the latest Governance Directions magazine about exactly this type of issue, the real economic challenge, leaders of a listed company, part 1, establishing the right understanding. The man who's authored both of those, please make welcome Mr. Dennis Kilroy.
Thanks.
It's just there.
And where's the pointer on it, Toby? Toby, the pointer is.
Yeah. Sure.
That's the pointer?
Should be the one, yeah.
Okay. All right. That's a good question, okay. So, thank you, Toby. And I would like to just beg the indulgence of the lawyers in the room, who I believe are numerous, because there's going to be a lot of diagrams in this presentation. And back in '88, when I was a manager at a firm called LEK, we were doing a big M&A deal, and the legal team was Allen's. It was led by a guy called Peter Cameron. And when we put our strategies in front of you in diagrammatic form, poor Peter had a left brain meltdown. He'd said, please give it to me in words. Well, we can't do this in words. It's going to be diagrams, so please bear with me. But what I really wanted to do today is demonstrate to you why it is just so important for the leaders of listed companies, be they executives or boards, but particularly boards, to focus on long-term value creation rather than just short-term financial performance. And this is from both an economic and a social perspective. And I want to begin the story by just making the point that over the, I guess, 25, maybe 30 years that the shareholder primacy paradigm has existed, or it really took root about 25 years ago, two types of listed company have emerged. The listed companies in developed economies have coalesced into these two groups. The first group we call long-term value creators. The second we refer to as short-term share price managers, and they are very different. The long-term value creators tend to have, or they do have, leaders who seek to build enduring institutions. They focus on long-term intrinsic value uplift, and they achieve that by pursuing customer value creation and shareholder wealth creation as joint and mutually reinforcing objectives. And importantly, picking up Larry Fink's point, they focus, or they put the interests of the company, and I guess by definition it's long-term shareholders, ahead of the often more vocal demands of short-term capital market players. The other group, the short-term share price managers, well, they're very different. Their primary focus is trying to maximise the share price or the market cap during the tenure of the current leadership team. They are far more interested in short-term market value uplift than long-term intrinsic value uplift. and they have a strong, almost myopic focus on earnings and EPS growth. But unfortunately, they operate from a flawed understanding, and this flawed understanding leaves them vulnerable to or hostage to the demands of the short-term capital market players, and we kind of know who they are. Larry just, well, through Toby, just spoke about them. Now, structurally, what I want to do today is three things. I want to talk about what's driving short-termism, and Larry did identify a lot of that, but I want to just make that a little bit more specific. And what you'll find is that, what I'll show you, is that one of the drivers of this is a misunderstanding or a lack of understanding. So I want to deal with that. And then I want to talk about what has to happen, or what can happen, to build an enduring institution that can create value for its customers and wealth for its shareholders on an ongoing basis. And it then has the option to do that in a way that at minimum preserves and wherever possible, if it wants to, enhances the well-being of the other stakeholders and particularly the wider community and the environment. This is very possible. So let's have a look at what's driving short-termism. Well, again, Larry's letter lays the scene, or lays the groundwork for this, but there's a lot of pressure on boards to focus on short-term financial performance or short-term financial performance outcomes. And that pressure tends to have two primary sources, and I guess this is an aggregation of the ones that were just mentioned. The first is self-interest on the part of short-term capital market players, and we all know who they are. The second is this misunderstanding or incorrect understanding on behalf of a much wider group. Retail shareholders, retail investors, some institutions, probably most of the business press, and even the odd proxy advisor. And this misunderstanding relates to the way the performance that a management team achieves in the market for its company's products and services translates into the capital market outcomes that are experienced by its shareholders. Now, more important, I think, than the nature or the source of this misunderstanding is the way that boards choose to respond to it, or this pressure, I should say. More important than the nature of this, or the source of the pressure, is the way the boards choose to respond to it. And often that response is grounded in the same misunderstanding that I just talked about. And this is unfortunate. You know, this misunderstanding is that the way that financial performance in the market for the company's products and services translates into the outcomes that shareholders experience. And unfortunately, the response, well, we call this response the EPS myth. We have a name for it. We call it the EPS myth. And it's the widespread but nonetheless misguided belief that enhancing short-term earnings or short-term EPS will create shareholder wealth. And the biggest problem of all in this is that because this is so widespread, it's effectively legitimised short-termism as a means for boards to respond to the pressure put on them by external parties with short-term objectives. It's a big problem. So let's have a look at this EPS myth, because we need to explode it completely. So the EPS myth, a lot of people, and there could be people in this room, who place a lot of stock in EPS as a measure of performance. There's a lot of people who think that EPS and price-earnings ratio in combination determine value, and that EPS growth and price-earnings ratio in combination drive value uplift. Well, that is simply not true. There's also people who think that EPS is a great measure of performance, or the performance that management achieve in the market for their products and services. That's also not true. Worst of all, though, is this belief that better short-term capital market performance stems from or flows from better short-term product and service market performance, or better EPS outcomes. This is definitely not true. Now, if I had a pointer, I'd point at things, but it's not quite working well enough. So just think of the first two there. They're really easy to deal with. I'm going to deal with them in one slide at a time. The third point takes a bit of effort it's a bit of a journey of understanding to get your head around this, but it's a journey that's worth taking, and I'm going to take you on that journey today. Because it's a very important one. And so let's deal with the first two things first. EPS. Exploding it. Step one of exploding it. We need to be clear that EPS growth does not drive value uplift and is a poor indicator of management performance in the market for its products and services, or the company's products and services. And the reason for this is it can be bought at any price. In fact, as a standalone measure, it's a particularly poor measure. Let me describe what I mean, or show you what I mean by being bought at any price. This is an example of just imagine three companies, A, B and C. They've got the same balance sheet, 100 million of equity in the balance sheet, same earnings, 10 million, same cost of equity capital of 10%. So they're economically break even. 10 million earnings less 10% of 100 is economic profit of 0. Now let's just...
Try this one.
Yep, okay, great. Thank you. And it's, which button is it? The one at the top?
Top green button.
Okay, and the...
Forward and back.
Okay, fine. Thank you. So let's also imagine now that this business, these three companies are able to grow their earnings by 15% per year over a 5-year period. And the first company does this by using less capital than the second one, which it needs as much capital as it needed earnings. So it's growing its capital base at the same rate as earnings. And the third one needs a lot more capital, and it's growing its capital at 20%. So you can imagine what happens. In 5 years' time, earnings is the same. It's doubled. Capital employed is very different. And economic profit is vastly different. The one that grew at the same rate remained economically break even, the one in the middle, Company B. Company A, it's economically profitable. Company C, economically unprofitable. Now, that's a fairly significant difference, but the consequences of that for value are huge because that gets capitalised. So it's a massive difference. Same EPS growth, one company stays economically break even, another becomes a real value creator, another a serious value destroyer. That's EPS being bought at any price. The second issue to deal with is, step 2 in exploding this myth, is to recognise that total shareholder return, TSR, is far more closely related to growth in economic profit per share than in earnings per share. In fact, it's not really related to earnings per share growth at all. So let me demonstrate this with 2 studies. One was done by Peter Contis and a team from the Yale School of Management. I think it was done in 2008 or 2009, but it covered the 10 years to 31 December 2007. It was looked at the S&P 500, and what Peter and his team were able to do was break the S&P 500 into 3 cohorts. The first one, EP dominant, were the companies whose economic profit per share growth was significantly higher than their earnings per share growth. The third one was the opposite, EPS dominant. Their EPS growth was significantly higher than their their economic profit per share growth, and a middle group that wasn't much different. What they saw from this over 10 years, so this is annualized 10-year TSR, a 6.6% difference in annual TSR. Now, those who watch these things, that's a huge difference, a huge difference. Now, we did the same thing in Australia over 5 years post the GFC, and we got much the same answer. What we found was a 6.4% difference. But importantly in Australia, we also took a look behind this. What was the underlying TSR? We stripped out the effect of market movements, which can distort it. And what we found was a 10.9, or roughly 11% difference in annualised TSR between the first cohort, the EP dominant, and the third one, the EPS dominant. So what does this all say when you wrap it all up? What it says is that if you want to build a bridge between the performance that a management team delivers in the market for its company's products and services and the capital market outcomes that its shareholders experience, don't do it with EPS growth and TSR, because the bridge will fall down. It has no essence to it. Now, what I do want to do now is show you how you can build a bridge, and it's a really interesting bridge, and it's a dynamic bridge, and it's a bridge that would be really useful in the context of that discussion that Fiona and Sam just had there, or that provided there. But to do it, we need to do 2 things first. There's 2 things that are leading to a third. We must first define what we mean by success in the market for our products and services, because it is unclear. Secondly, we must define what we mean by success in the capital markets, because that's not even clear at the moment in many people's mind. And then we need to show how to build the bridge between them. So let me do that. I'm going to start by showing you what success in the product and service market really means. It means being economically profitable. It means having a return on equity greater than the cost of equity, or it can be a return on capital greater than the cost of capital. It actually doesn't matter. Meaning we're economically profitable. But once you become economically profitable, there's a transition occurs. And the measure of success changes from being economically profitable to having a growing stream of economic profits. And that's achieved by either making it more economically profitable or growing the capital base on which that economically profitable return is earned. So those are the two measures of success that you move through. Capital market success is not that dissimilar. It means having a TSR greater than the cost of equity. TSR greater than the cost of equity. In the product and service market, it's an ROE greater than the cost of equity. In the capital market, it's a TSR greater than the cost of equity. It's the same cost of equity. It has nothing to do, or virtually nothing to do, with your TSR performance versus a selected basket of peer companies. It has a little bit to do with performance versus an index, but not every company has exactly the same risk profile as the index. And it's actually, but the problem though, the only problem with TSR minus KE is that it's a long-term measure. It works over the long term, 10, 15 years. In the short term, you get a quirky problem, which is, well, it's a little bit of a problem, which is that in a rising market, it's relatively easy to get a TSR greater than the cost of equity, and in a falling one, it's quite difficult. But that's why we had that TSR alpha thing before. We stripped out the effect of market moves and got to the underlying measure. So that's the two measures of success. How do we bridge between them? Well, the first thing we need to do in that is we have to link economic profit and value. I'm going to do this two ways, simplistically and then properly. Simplistically, just to bring you halfway, and then fully to really nail the story. So that is a simple business. We're going to make it a perpetuity, actually, but that is a business earning a 30% return on equity on an equity base of 100. Its earnings are 30 million. If its cost of equity is 10, its charge for capital is 10 times 100, which is 10. 10% of 100, which is 10. Its economic profit is 20 million. Now, if we treat that as a zero growth perpetuity, earnings and cash flow are the same in a zero growth perpetuity. So the value, the intrinsic value of that business is $300 million. 30 million earnings divided by 10% cost of equity. But we can get to that number another way, which is earnings plus the present value of a constant 20 million a year economic profit stream. So that's 100 of equity plus 20 divided by 10% gives us 200. That's a perpetuity, but unless you're going to buy one from an insurance company, perpetuities don't exist in the real world. No business out there is going to do that until hell freezes over. What you do get is something quite different, but it's based on this understanding. And we call this a bow wave of expected economic profits. So there's our business again. What actually happens is something like this. That bow wave, it looks like a child's slippery dip. It has a height, which is economic profitability. It has a width, which is the amount of capital on which you're getting that economically profitable return. And it has a length, which is the sustainability, or otherwise, I guess, of a positive economic profit stream. Now, interesting point to make about this is that the market forces, which were identified there, push economic profits to zero over time. It has a natural datum or benchmark of zero. This is not true of earnings or EPS. They do not. So unlike those, this one drives to zero, and it's a very, very important characteristic that I'm going to make use of in a moment. So as we start, let's use this bow wave to build a bridge. So in every listed company, at every point in time, there is a bow wave of expected economic profits embedded in the share price or the market capitalisation. If the management team deliver an economic profit stream commensurate with or equal to that bow wave, they will meet expectations in the product and services markets, they'll preserve wealth in the capital markets, and they'll get a TSR equal to the cost of equity. But if they succeed in making the bow wave higher, wider, or longer by the way they choose to participate in the market, a lot of this is to do with capability creation, then they will exceed expectations in the product and services market, they will create shareholder wealth in the capital market, and they'll deliver a TSR greater than the cost of equity. Now, here's where the short-termism thing comes into play. You do not get a higher, wider, and longer bow wave through short-termism. You might get a higher one for a year or two. It's probably going to be a bit narrower, and it'll sure as hell be shorter. And the volume under the slippery dip will be less, so shareholder wealth will be destroyed. How do you make a bow wave longer? Mostly it's about individual and organisational capability creation, just what was mentioned a few moments ago. That's how it's done. And one of the most important capabilities is the capability to come up with new and higher value strategies, which we'll talk about in the solution to all this in a minute. But So that's how this works. But we do need to take the thinking one step further by showing you a pair of bow waves over a measurement period. So what was it at the beginning and what was it at the end of the measurement period? It's very insightful. But to do this, we have to go to 2 dimensions, not 3. A 3-dimensional bow wave gets a bit hard to do the numbers. So it'll really give the lawyers left brain meltdown, I tell you, if we did that. So let's look at a pair of bow waves. This is a pair of bow waves for a hypothetical company over two bow waves, one as of 1 July 2010, 1 July 2015. The vertical is economic profit in dollars this time, not percentage, so it's 2-dimensional. It's like the planes on the previous slides. The amber line is the 2010 one, I should say. And what it has, the first 5 years of this are either it could be an internal forecast, but in this case we used consensus analyst forecasts. What comes after that down to here is the remaining economic profit stream required to justify the share price here. So that is built into the share price 5 years ago. If we roll forward 5 years, we have a blue bow wave. Now, this bow wave has one extra component in it, which is the EP that was actually delivered over the 5 years, the measurement period. But then we have the same kind of thing happening. Consensus analyst forecast and what's required over time beyond that to justify the share price now. Now, what's interesting here, very interesting here actually, is this is hypothetical in a sense, but this business underperformed. It failed to deliver the EP expectations in place at the beginning of the measurement period. But it more than offset that through a set of new and higher expectations that it created that need to be delivered beyond the measurement period. Now, why this is particularly interesting is that while that's a hypothetical construct, it's a construct that looks almost identical to what occurs in the majority of the better performing ASX listed companies, the better performing ones. And it also captures the 2 fundamental sources of wealth creation that exist for every listed company over any measurement period. Could be 2 years, could be 20 years. That red area, because it happens to be red here, but that first area and the second area represent those 2 things. It's the value consequences of meeting the expectations that the market had of you in economic profit terms at the beginning of the measurement period, plus the extent to which during the measurement period you were able to create a new and higher set of expectations to be delivered beyond the measurement period. The 2 components of wealth creation. And let me illustrate that point I was making about the top performing companies. I've just got a few of them here. I've got 7, but I've chosen these 7 for a reason. Not that they're top performers, they're just that they happen to be good performing companies, solid companies, and 4 are established and 3 are relatively new. They all created serious amount of wealth for their shareholders over the last 5 years, all created more than $1 billion, well, many billions of dollars, particularly Telstra. But what's interesting is this. Of the established ones, they all destroyed substantial amount of shareholder wealth by failing to meet the expectations in place at the beginning of the measurement period. But they offset it by creating these new and higher expectations, so to be delivered beyond it. So it's the red and the green areas from the previous slide replicated in those numbers. And interestingly, they increased the length of their bow wave by 25 to 30 years. Let's look at the more new companies, the more high growth, relatively new to the market companies. They all just made it over the line. They just made it in terms of meeting the expectations that were in place at the beginning of the measurement period. But in every case, between 90 and 99% of the wealth creation came from creating new expectations beyond the measurement period, or to be delivered beyond the measurement period. And they increased their bow wave lengths by 20 to 30 years. So it's interesting. This is a rhetorical question, but it's an interesting rhetorical question to pose, particularly for those who watch what happens with remuneration plans and so on. What do you think would have happened in these companies in particular, but also here, I suppose, if the management team had spent a lot of their time worrying about making this green, particularly by meeting these stretch targets? So stretch targets are probably the biggest problem we have in executive, or the second biggest problem we have in executive reward. But meeting stretch targets here, rather than building the individual and organisational capabilities and strategies necessary to deliver this. The simple message in this is don't sweat the short term, focus on the long term. There's nothing in it by sweating the short term. Now, One thing that happens with companies who do sweat the short term, particularly over the last 5 years, is they have they've spent their money on higher dividends. And let's have a look at this. Now, in this case, we're going to look at the top 300. It says ASX 300, but it's actually the top 300, largest 300 listed companies, both for the 5 years pre the GFC and the 5 years after. And we compared what they did, and it's very insightful. In the 5 years post the GFC, these 300 companies, as a cohort, produced a TSR of annualised of 4.8%. But there were 4 groups within them, and they are really clearly identifiable groups. The first are what we call the sustainable growers. So if you compared the 75 of them, if you compared what they did before and after the GFC, or so what they did across the GFC, if you like, so comparing the pre to the post GFC outcome there, their payout ratio decreased and their capital growth increased. And they delivered a phenomenal TSR as a cohort of 17% per year. The next group are the sustainable yield chasers. These are the guys who, or the companies who were chasing this idea of paying dividend yield in a low interest rate environment. There were 40 of them. They increased their payout ratio. They also slightly increased their capital growth, and they produced a 7.1% TSR. The next group, we call them managing for returns. These are companies who were decreasing their payout ratio and they're also decreasing capital growth. They're sort of trimming back. They got a 1.3% TSR, but the prize goes to the unsustainable dividend yield chasers. Biggest group, 35% of these companies. They significantly increased their payout ratio. They decreased their capital growth and they produced a negative TSR. So not a great performance. Say if their cost of equity was 10%, it's really a negative 12, not negative 1 or negative 11.8. So pretty bad. So that's the understanding that I wanted to put in place around this. I now want to just talk about what you do with this. How do you actually go about building an enduring institution that can create value for its customers and wealth for its shareholders on an ongoing basis? Those are really important words. And also, if you choose to do so, to do it in a way that at minimum preserves and wherever possible enhances the well-being of all the other stakeholder groups involved. How do you do that? Well, it comes down to 2 things, skill set and mindset. And they go hand in hand, or sort of brain in brain, in a sort of left brain, right brain sense. You've got to have both. One without the other doesn't work. So I'm going to talk about the skill set side first, and then I'm going to talk about the mindset, and then I'm going to open it to questions. So the skill set at an organisational level comes down to establishing 3 core capabilities. The first of them is the ability to measure value. And when we're talking about measuring value, we want to understand the value of the business at a disaggregated level under its current strategy. So essentially this tells you where you're creating value, where you're destroying it, and why. But for a board, an absolutely crucial part of this is to know, well, what is the expectations the market has of me? What EP are they expecting us to deliver over the next 3 to 5 years? And will the company's current strategy actually deliver that or not? If it won't, then you need a higher value strategy just to justify your current share price. And if it will, then you need a higher value strategy to exceed expectations and create shareholder wealth, because most companies want to create shareholder wealth. Which means the second capability, the value creation capability, is the key, and it really is. And this is a highly creative process, and you actually do need to learn to use your left and your right brain at the same time to do this properly, and that's a very learnable skill, as a couple of people in this room know. Now, it focuses, when you're creating value or creating wealth, it's really customer value and shareholder wealth together. And it's not one to the exclusion of the other, it's done together. And it's best done at the level of a needs-based customer segment. By that I mean a group of customers whose needs are so similar that you can serve them in a way that's value-creating for them and cost-effective for you. Because if that's the case, then you'll be able to create shareholder wealth as well as create customer value. So it all happens at a segment level. And let me give you a picture of what this can look like. And this was with a manufacturing business that we were involved with, I think it was about 2002, but it doesn't matter. It was a capital-intensive, old-style manufacturing business. It had 14 segments, and there were 10 value creators and 4 value destroyers. 2 years later, this is what it looked like. Yes, here we go. Value creators, value destroyers. That was achieved with 4 initiatives. each of them segment specific. Let me just explain what they were. They found a higher value strategy. They came up with a new value proposition here for customers and turned it into a higher value strategy at a segment level, and that's what it became. In this segment, they identified a process improvement that made it more efficient, but that efficiency actually had a consequence across many of the other segments because it was there was a major shared asset. It was actually glass manufacturer in another part of the world to Australia. And the third thing they did was to migrate this bunch of, I've hit the wrong button. It was to migrate some of these customers into this segment. The fourth thing they did was enter a new segment, which is this thin one here. But in a period of 2 years, they added 50% of the value of a business that was pretty basic business. Now, what's interesting about this from board's perspective is two things. One is that if you, as a board, or if your boards chose to set themselves a high-level goal, they might not communicate it, but they might have it inwardly, a goal to double the value of the business in 5 years, the chances of doing that by adding 20% to the value of every segment every year is zero. It's never going to happen. But if you did adopt the approach that we've typically adopted, and this company did, and others have, to seek to double the value of 1 in 5 segments every year, then you're in with a chance. And in fact, that's the way it works. And so you're adjusting one segment. If you've got 15 segments, you might do three segments a year, maybe one year, maybe 4 another, maybe it's 2 the year after that, whatever's appropriate. But you leave all the others alone. So you're not stirring and perturbating the business with new strategies all the time. It's just at a segment level. And so that's how it works, and it's extremely powerful. You can do it. The third capability is the business process stuff, and this was talked about in the last session as well. So this is a value management capability. These processes are essential, and every organisation has them, but they need to be tuned towards the goal of building this enduring institution that can create value for customers and wealth for shareholders on an ongoing basis. Now, one aspect of this that requires a lot of tuning, not just in Australia, but it certainly does in Australia, is the executive reward one. I'm going to talk about that a little bit because I see it as a problem. We don't work in the space of executive reward, we just suffer from the consequences of poor executive reward, not as investors, but as people working with companies who can be pushed in the wrong direction by poorly thought through reward plans. And so most executive reward plans in Australia for listed companies, at least the LTI component of it, is built around relative TSR and augmented by EPS growth, a structure firmly rooted in the EPS myth we talked about earlier. I actually touched base with one of the leading REM consultants this morning, just checked with them what's the proportion of companies that are doing that. In the ASX 100, 77 companies use relative TSR, and of those, 46 use augmented with EPS growth. Now, the problem that creates is that often the relative TSR thing just goes in the bottom drawer because it's a bit of a lottery. You don't know what's going to happen. You find out at the end of the 3 or 5 year period. So the conscious focus goes onto EPS, and that drags in all the short-term problems we were talking about before. So if a board wants to get their head around this properly and think about an approach to reward that does align product and service market performance with capital market performance, try this. There's 3 ways you can go about it. Thinking from the capital market side, you can use TSR minus KE, TSR minus the cost of equity. But bear in mind it's better in the long term. So if you can get to a point where you can get a 10-year vesting period or something like that, or 15 would be even better, that's perfect. But you can strip that easily into 2 components, the value consequences of underlying market movements and the value consequences of doing better than that. And that is the TSR offer approach there. But by far the best approach, I believe, or we believe in my firm, is the pair of bow waves thing. So the red and the green area, the value consequences of meeting the expectations that were in place at the beginning of the measurement period, plus the value consequences of coming up with new and higher EP expectations to be delivered beyond the measurement period, focusing on capability creation, new strategies at a segment level, a more innovative path forward. So that's the understanding I wanted to give you. I now want to talk about the mindset. Oh, that's the skill set, side of the response. Now I want to talk about the mindset. And this is something, we could talk about this for 2 days. This is such a big topic. And there are ways to adjust people's mindsets, and they're not that difficult. But you need to know what you want to adjust them to. Now, there's 2 things I want to talk about here, and then I'm going to go to questions. The first mindset shift that's really essential is this, that we must understand that to improve short-term capital market performance or outcomes, we've got to focus on long-term product and service market outcomes, not short-term ones. Now, that's completely alien to the way that most people think, but it is true. The second is far more important than that, even though that's important. The second is to realise it is not about creating shareholder wealth per se, and it never has been. I was a partner in the firm that brought value-based management to Australia. It was not about all the things that have happened since then. It's about building an enduring institution that can create wealth for its shareholders on an ongoing basis, And why the ongoing basis thing is so important is that when you realise it's on an ongoing basis, the way you go about creating shareholder wealth matters and matters a lot, because the way you go about it determines your ability to do it on an ongoing basis. So you must think differently. Now, there's three critical elements to be able to create wealth for shareholders on an ongoing basis. The first is to recognise that it's about embracing customer value and shareholder wealth as joint and mutually reinforcing objectives pursued in tandem at the level of a needs-based customer segment, like that diagram we showed before of the glass company. The second is to have a noble purpose beyond maximising shareholder value during the tenure of the current leadership team. Now, that's a big topic as well, and the whole conscious capitalism world is about noble purpose as well. But let's put it in the context of the segments. If you're trying to create customer value and shareholder wealth at a segment level, and you're trying to do it on an ongoing basis, think about the type of custom value you want to create. And I'm going to define a polarity for you. At one end of the polarity, I'll say, here's real or authentic value for customers. And over here, artificial value for customers. And you say, what's the difference? Real value for customers is value or benefit embedded in a product or service, the consumption or use of which enhances the well-being of the user, enhances customer well-being. Artificial value over here is value created by satisfying a desire that you've created in the first place with a consumer marketing campaign or clever marketing campaign. No thought of well-being there. Now, the reality is life is we probably sit somewhere in between in most organisations. Tobacco probably sits pretty fair and squarely over there, but there's a spectrum. My thesis, or my point to you here, is that think about where you are, think consciously of where you are on that spectrum. And the more you are towards the right-hand side, as I look, my side, right, the more likely it's going to be a noble purpose in the business. And that's important because a lot of the costs and a lot of the things that people externalise, like the health consequences of fast foods or whatever, eventually become internalised. If nothing else, they finish up as an actuarial liability on the balance sheet when the class actions start. But it shouldn't be that. It should be about well-being. A lot of the concerns that people are having about company performance, it's like the TQM movement in the 1980s, total quality management in engineering. And I started life as an engineer, so I'm familiar with that. The Europeans used to inspect poor quality out. The Japanese built good quality in. We need to do the same with behaviour. If you have an attitude of building in ethical behaviour rather than inspecting it out, it's different, but it requires a mindset shift. The third thing that needs to happen to have this ongoing basis approach is, quite simply, seeing your stakeholders as allies in the creation of wealth or value over the long term, not adversaries in the creation of profit over the short term. It's a choice. It's a choice, and I know what choice I make. I know what choice I do make. Choose to think long term, because the longer the time frame, the more the incentives or the interests of all of the stakeholders align. So it's your choice. Questions, please. Okay.
We do have quite a few, and there's a common theme, which is, you know, what about the metrics? As behaviours, you know, how people behave the way they're measured. So there's a comment on, in light of your comments, what metrics do you do to get a long-term plan? And things is also, based upon CEO tenure being shorter than it used to be, how do you apply the metrics in case?
Okay. Yeah. To the metric question first. And if you're thinking about business planning processes in an organisation run this way, the business planning process is evaluating alternative strategies and choosing them based on value or something else. So you've in a sense, you know what performance you're going to deliver, because it's the performance that caused you to choose that strategy from amongst the others, probably lower value ones that you discarded. So being on track with that strategy is an indicator of good performance. But without the strategy bit, just focus on economic profit growth. Forget about earnings. Earnings is part of it. Earnings is not an incorrect measure, it's an incomplete measure. But standalone, it's a problem. Now, that's only half the question.
But do the remuneration plans that are put in place for executive directors and so on, does that actually counteract what we're talking about?
It does
here?
to some extent, yeah. Because, and the problem has been that certain people have promoted and put a lot of pressure on companies to go down the EPS relative TSR path. And it's an unnecessary pressure. And as one person who's going to remain nameless, but a very senior non-executive director said to me, that pressure causes many directors to take an approach of I'd rather be wrong than be different. There's safety in numbers around doing the same thing.
Sure.
And the two strikes rule has created
Well, and that has come up here about the two strikes rule, about not actually meeting your targets, even though they may have a longer term plan in place. And the question, another question here is is it going to be too hard to get proxy advisors and so on, who are often, I suppose as you mentioned before, lobby groups as such, when they're looking for short-term gain, how do we get them thinking in longer term as well?
It's education. I mean, one of our greatest frustrations is that we work with companies for a couple of years and they get all this, and then just 2 or 3 changes of management, and people have come out of university or they've just done an MBA, they come in and they replace it with the old thinking. And we go back to an earnings approach.
So you were saying, if we're talking about education, then how do we educate shareholders too?
Well, this institute could do it, potentially. I mean, no one else seems to have the will to take a lead. The Governance Institute, in my view, more than other organisations, seems to be prepared to have a go at doing the right thing.
Sure.
Things right.
There's an instantaneous question here. It's just come literally. Do you think the area of sustainability in the focus? And recently I've seen a chief of sustainability as being a C-level board member. Will this grow to support long-termism as well? So the act of thinking longer-term forecast, do you think it'll support your cause?
So long as the sustainability is not just an environmental sustainability, it's a business sustainability. And to that point, I think your issue of GOOF or GOOF, whatever.
What was one of the ones I came up with? COG.
Okay, you could call it conscious governance. What conscious means is that you are fully aware, fully in the present. You're thinking about all aspects of it. That would be a very powerful name.
Well, now, what's come up is everyone's saying, geez, that was fantastic. There's a whole lot. My left brain is really struggling with the diagrams. I need to look at them again. So a number of people are saying, could we have a look at the slide pack? But in this month's governance directions, on page 653, as an example of December 2015, there it is. You've got an article in there that has a lot of these.
That's the first half of the story. The second half of the story, which isn't in there today, will be in the 1st of February one.
There you go.
So it's a 2-part thing. But
will you make the slide pack available?
Yeah, definitely. Peter's organised that, I believe, or ran it.
Fantastic.
But also, we do seminars. People can have a day exposure to this. Learning, when you're getting this, one of the things you need to learn need to understand is that it's good to get left brain meltdown, because it pushes you into a state where you rely on your intuition, your right brain. It's a really good thing. And then you need to learn to use them both together. It only takes about 15 minutes to learn how to do that.
Yeah,
you've got to practice.
I'm going to create even more meltdown. The neuroscientists that I've been dealing with are doing research into bunches of neurons around the stomach.
Yeah, the gut thing.
The gut brain, which they're saying is enough neurons to be the equivalent of a cat brain.
Yeah.
And so when your gut says it's wrong, it's listening to it's the hard part when the left brain, the rational side of things, you're saying. There's also a heart brain as well. Yeah. So, and at the risk of sounding extremely crass, I know the women think men have another brain also, but they're actually researching that as well to say that that's significant in decision making.
And I'm going to say, I'm going to let you off the hook here by saying it's nothing to do with the brain, it's everything to do with the mind. It's the conscious mind and the unconscious mind. So if you have a conscious intent, it's important to align your unconscious beliefs with that. Otherwise, you'll trip yourself up. And it's not that hard to do. There's 2 people, definitely maybe 3 in this room, who've been through the journey of how that's done.
Yeah.
Less than a day to learn.
Can I say what's important here is, I know this sounds overly simplistic, but it's about doing the right thing.
It is. But having the
really understand to
having
do
the
right
intention
thing.
To do the right thing. Yeah. Outcomes can be positive or negative to varying degrees, but there's no such thing as no shades of grey when it comes to intention. You either intend to serve or you intend to exploit. You can't have a foot in each camp.
No, you can't.
You can have an outcome, not an intention.
Yeah. Ladies and gentlemen, on that note, would you join me in thanking Dennis Kilroy? Fantastic.
Thank you.
Thank you.